I rarely short stocks. I've told you that on this channel before, and I believe it most of the time. Riding a short is not a long-term strategy. I think most people who try it, they get crushed. But I've been sitting on a specific question the last couple weeks. Is there a setup where the math actually flips? Where the shorting stops being a bad bet and starts being the right one? And I think I found it. Not a feeling, an actual rule with a specific window and a specific position size. And behind all of it, one number. That's what's got me looking into this in the first place. Fun fact, and this is the number I just mentioned. As of June 2026, Americans are borrowing against their brokerage account at the highest level ever recorded, over $1.5 trillion in margin debt, up almost 8% in a single month, up over 50% from a year ago. As a share of the whole economy, that's roughly 4.5 to 4.7%, the highest that it's ever been, higher than right before the dot-com crash, higher than right before 2008. And here's the part that actually got my attention. Every time in history this specific number has spiked like this, 1929, 1987, 2000, 2007, a crash almost immediately followed after. Every single time. So that number's been sitting in the back of my head for a while. And then I watched a video from Andre Yik about what just happened to South Korea's stock market. And it clicked. Because Korea just lived through almost exactly this. 3 weeks ago, it was the best performing market on earth. Up something like 200% in a year. Then it fell apart. Worst month in the index history. And the mechanic was leverage. Regular people were trading on borrowed money. A lot of it through leveraged ETFs. And once selling started, brokerage forced liquidating accounts that couldn't cover their margin calls, which pushed prices down more, which triggered the next round. That part checks out completely. SK Hynix had its worst single day ever, over 15% in a day. Before I use this as my proof point, a quick note on something I flagged when I first wrote this. I went looking for specific numbers, Yik cited. 3 trillion won liquidated. 1.2 million accounts hit with margin calls. The first pass I did only turned up a few hundred billion won for July alone. Since then, more reporting's come out, and the fuller picture is bigger than I had originally had it. The 1.2 million accounts hit with margin calls, the number's dead on. Total forced liquidations, once you count from when the selling actually started back in May, instead of just July, 2.3 trillion won. So, the mechanism's real, the account number checks out exactly, and the number is closer to right than I gave him credit for in the first time I had looked. That's on me for only checking the most recent month instead of the whole run, and who knows, he has different sources than I do. Now the part I really wanted to dig into on my own is whether the US setup really rhymes with Korea's. Because the S&P has 500 companies, we're fine, is the lazy answer. And I don't think it's true. The S&P as a whole is diversified. But the specific trade everybody's piled into isn't the whole S&P. It's AI and chips. Look at just the semiconductor ETF SMH. The top 5 holdings, something like 47% of the fund, Nvidia alone is 21%. That's not 500 companies carrying the story. That's a handful of names, same as Samsung and SK Hynix were carrying Korea. And the leverage piece isn't hypothetical either. The same category of product that wrecked Korea's retail accounts, leveraged single stock ETFs, is a real actively traded thing here right now. There's a fund that doubles Nvidia's daily move, one that doubles Tesla's. People are holding these things the same way Korean investors leverage Samsung bets. On top of that, something like 6 out of every 10 options traded on the S&P right now are same-day contracts, and Tesla and Nvidia alone are half of that flow. Not to say that to be dramatic, it's just where we're at. So what would actually trigger it here? Watch capital spending. specifically the 4 companies spending the most building out AI data centers. The whole story right now is Nvidia sells the chips, the cloud companies buy the chips. That spending shows up as revenue, and the market rewards it. The day one of them says on an earnings call, "We're pulling back," that's the test. This has already happened once back in 2000. Coca-Cola cut an order with Cisco, 10,000 routers to 2,000. Didn't sound like much. Cisco's earnings collapsed, and the NASDAQ fell 78%. One customer, one order. And there's a real person already betting on exactly this, which I think is more useful than a hypothetical. Michael Burry, the big short guy, disclosed earlier this year that roughly 8% of his portfolio was put options against Nvidia and Palantir. More recently, he disclosed a short on Micron, a refresh short on the semiconductor ETF, shorts on Tesla and Nvidia. That's a real name person with a real disclosed position. To be fair though, because I don't want to hand you a one-sided story, some of the other well-known AI bears have reportedly disclosed their short books around the same time. It's generally split. It's not a consensus call. Here's where I want to be straight with you, because this matters more than any number that I've given you so far. Shorting anything is at its core a market timing bet, and I don't love timing bets. I don't ride out short positions. Never has been a long-term strategy for me. I don't think it should be for you. So if you're watching this thing thinking, time to short Nvidia, I'd push back on that. But I don't think the answer is never short either. I think there's generally a window where the risk and reward line up. And I want to show you my actual thinking on it, not just hand you a conclusion. All right, my actual take. The window where shorting actually makes sense is between the moment where something visibly breaks, like a real black swan, and the moment the government, the Fed, responds by printing money. Whatever that specific tool they use to do it, once response shows up, that's the signal to cover. Before the break happens, I wouldn't put more than something like 1% of my portfolio into it, because you don't know when it's coming, and early is the same thing as wrong. Does that actually hold up? Let me give you the real cases instead of just asserting it. 1987. The market crashes 20% in a day. Greenspan puts out a one sentence the next morning saying the Fed will provide liquidity. Backs it up with a huge cash injection the same day. 2 days later, the market had already recovered over half of its losses. Window was about 1 day. Nobody's trading that in real time. 2020. The Fed's first move in mid-March didn't work. The next day was its worst drop since 1987. 8 days later, they came back with unlimited, no ceiling. That second announcement landed almost exactly on the bottom. That's the clean version of the rule working. 2008 is the one that should worry you. Lehman collapses in September. A month later, Congress passes the $700 billion bailout. Market keeps falling. 2 months after that, the Fed announces actual money printing, buying mortgage bonds. Market keeps falling. The real bottom didn't show up until the following March. Almost 6 months after Lehman, months after 2 separate "they're printing now" moments that were not actual signals. And then the dot-com really complicates it. The Fed started cutting rates hard in January 2001. 11 cuts that year. About as clean, easy money signal as you can get. The NASDAQ kept falling anyways for another 21 months, losing nearly 80% of its value before it actually bottomed. Printing, or in that case just cutting rates hard, did basically nothing. So here's the pattern I take from those 4. When the problem is pure liquidity freeze, people can't get cash, credit seizes up. Throwing money at it works, and works fast. 1987, 2020. Same story with a bank run in 2023. That got contained in about 2 days. But when the real problem, the story that people believed in, just stopped being true, that's the dot-com, And honestly, the first few months in 2008 too, money doesn't fix that. It just reinflates prices after the repricing's already run its course. And that can take years. Sadly, this setup has both at once. The margin calls, the forced selling, that's a liquidity problem. The kind that responds fast to a big backstop. But it's sitting on top of a real question about whether the AI spending story actually pencils out. So a printing signal might tell you that the panic's over. It might not tell you the price is done falling. One more thing that makes me want to keep this small right now specifically, the Fed. As of I'm recording this, it's not in we'll do whatever it takes mode. New chair and actual inflation hawk, most of the committee currently leading toward raising rates, not cutting, because inflation's still elevated. A lot of it from the same energy situation I've talked about before. That's not the 2020 Fed. That's closer to the 1970s style buying, wanting to help the market, but boxed in by inflation. They can't ignore it. If this breaks while that's still true, the signal I'm telling you to wait for might take longer to show up than any of the examples I gave you, which makes me more confident in the 1% rule, not less. Shorting isn't for everybody, and it shouldn't be most people's first move. So a few ways to think about this that don't involve betting against anything. 1. Instead of a fund dominated by the same 10 AI adjacent names, there's an equal weighted version of the S&P where all 500 names get roughly the same size position. Doesn't get you out of the AI exposure entirely. Just stops that exposure from being able to sink the whole thing the way Samsung and SK Hynix sank Korea. 2. Plain cash, specifically a treasury-only money market fund. Not a prime one. Prime funds also hold corporate debt. And in 2008, one of the biggest ones actually broke, dropped below $1 a share because it was holding Lehman's commercial paper when Lehman collapsed. A treasury-only fund doesn't have that exposure. If you're still in cash waiting to see what happens, which one you pick actually matters. 3. The boring sectors: utilities, staples, healthcare. During the dot-com crash, while the S&P was down 50%, staples was still putting up double-digit annualized returns. Utilities did even better. Boring wins sometimes. And 4. Gold. I'll be honest, the price targets I've seen the big banks put on this year range from $4,900 to over $6,000 an ounce. And a spread that wide tells you these forecasts are not facts. Now, I've said cash is trash before, talking about the money printing side of this. Not a contradiction, just timing. Cash is the place where you park while you're waiting to see something breaks. Fine, that's what I'm describing here. Cash is somewhere you want to be once they actually start printing. Still trash, long term. Haven't changed my mind on that part. So here's where I land. That margin debt number's real. It's not just Korea's problem. The concentration and leverage part are sitting in the same place here. Different ticker. I'm not telling you to short anything. And if you take one thing from this, take the 1% rule, not the trade. But if you want to know when I'd actually get more aggressive about this, it's after something visibly breaks and before the money shows up. And right now, with the Fed in the mood it's in, I think that gap could be wider than usual. Credit where it's due. That Yick video is one that showed me this mechanism actually happening in real time instead of just theory. Worth a watch if you want the original. One more thing before I go. There's a company that's doing almost the opposite of everyone else in this story. Spending a tiny fraction of what its competitors are on AI, sitting on a huge pile of cash instead. I've got a specific idea of what they do with that cash, and it's worth a video on its own rather than tacking it on here. Good luck, take care, and bye-bye.